Hello everyone and welcome to TIOmarkets webinar. It's me, Janne Muta, Chief Market Analyst for TIOmarkets, and I'm going to introduce you to a best trading strategy on RSI indicator. There's a lot of misunderstanding on how to use RSI, and I want to set things right for you so that you can learn what kind of RSI strategy is best for you. So let's just dive into this subject, and because this is a live webinar and we are kind of all traders here, I want to hear your questions throughout the webinar, so feel free to ask questions. I'd love to help you with all the questions that you have, whether they are RSI related or not. But you know, if there's lots of questions coming in, I can answer them afterwards in the next webinar, or I can answer you via email. But at the moment, let's try to stick to RSI questions, but I'm always happy to consider other questions too. So first of all, if you haven't done so, go to TIOmarkets.com/contact and learn more about VIP Black, because you get really tight spreads and no commissions per lot. So it's really a great offering. Most of you know my background already. I've been trading futures, managing portfolios, working as a Chief Market Analyst before, and currently I'm working for TIOmarkets, helping you guys to succeed in trading. So that's close to my heart and very important to me. So I hope that you ask a lot of questions, because that helps me to understand where you are in your trading. And you will get a video recording afterwards, so you don't have to worry about taking notes. Now, this workshop is really all about RSI. So I'm going to cover the basics so that new traders know where to start, how to use the indicator. But then I'm going to give you 4 different trade entry signals, and then we talk about the market regime. With market regime, we basically mean that we either talk about ranges, uptrends or downtrends, and then about trading process and position sizing also. Now, in order for you to actually go and start taking the full benefit of what you learn here today, you need to know, you basically have to have a trading account. So I would encourage you to go to TIOmarkets.com and just fill in your details and get an account for yourself. This is basically, if you go to TIOmarkets.com, click this register button here, fill in your details, and you get an email from us. You get the wallet ID and a password, and then all you have to do is to log in, open a demo account, download MT4 or MT5. And once you do that, you get another email where you have the account number and a password for the trading platform of your choice. So this is very simple, very easy. And obviously, I'm just quickly going to show you this too. So very sort of simple setup here. If you go to the website, you can open live accounts or demo accounts. The process is exactly the same. Just click here and then go to Download Center. Here you can choose MT4 or MT5, and if you go to deposit, you can find the deposit options here. Quite simple and quite easy to do. And this is one important bit. If you ever happen to lose your account, a demo account password, just choose the account, go to account settings and then reset the password, and you'll get an email from us again. And as usual, you shouldn't watch this video or attend this webinar if you don't agree with this disclaimer and the fact that we do not provide any investment advice. So this is all for education and marketing purposes only. Now, regardless of whatever indicator or whatever indicator settings you are using, the most important analysis that you have to do, it's about the market regime or the trend or momentum. It's basically, we're talking about the same things, whether we talk about regimes or momentum or trends. So if you don't know what the market is likely to do, then it's really hard to apply any indicator. It's really difficult to understand what's happening, why things aren't working out if you don't actually understand what the context is first. If the context is that you have an uptrend, then obviously the market is going to trade differently, and the indicator indications are different, or they should be interpreted differently. So let me move forward. Do you have a range or a trend? So like I said, before you even think about what the market is likely to do, or what the indicator is actually messaging, what the market is likely to do based on that indicator message, you have to understand whether you are trading in a range or in a trend. Rules are different for all of these market contexts. If the market context is uptrend, then you're looking to buy at support and hold. If you're trading in a range, then you're looking to buy at support and sell at resistance. And obviously in downtrend, you're looking to sell at resistances. So let's cover the basics first. Any indicator that we are using, that there might be very complex and highly advanced indicators that institutional big money traders use. But any indicator that we use as retail traders are kind of simple. That's a simple mathematical equations, and they plot a line or set of lines on our charts. And in this regard, RSI is no exception. So we shouldn't expect that the simple line that RSI plots could be a good explanation of what the market really is doing. We need to give the context, we need to give the indicator its meaning by applying it correctly. If you apply it wrongly, it just causes you to lose money. So market is really very, very complex and complicated structure, or you could call it a process also. So how should we think that a simple equation that moves an oscillator up or down, how should we think that this would actually be able to explain the market fully? Yeah, the truth is it doesn't. So remember now, and throughout this presentation and throughout your trading career, that all the indicators are just indicators. So that is highly important to keep in mind. RSI is called a relative strength index, and this is a little misleading because it really doesn't measure any relative strength of the market. For those who wonder what relative strength is about, a very simple explanation in 20 seconds. If you have two markets moving up, say for instance higher, and one is moving up stronger than the other, then the one moving up stronger is relatively more strong. It has more relative strength than the one that is moving up but at slower pace. So that's what a relative strength analysis is about, and you usually do that with stocks in stock markets. But here we're talking about an oscillator that really isn't measuring any relative strength at all. It's actually just pointing to where the market is likely to be in a recent range. Depending on the settings that you use, then the RSI indicator is either very responsive or it's kind of sluggish and moves a lot between the blue and the red line here. Now, I'm going to show you using MT4 here, that I'm going to show you the settings and how they impact the RSI. So if you right click the indicator, first of all, how to insert this is you go to Insert Indicators, Oscillators, and you choose Relative Strength Index there. But once you have it on your chart, if you right click on it, you can open a settings box. And here, first of all, you can change, if you double click these, you can change these settings. But more on those later, so you understand better what this is about and why you might want to consider these. I usually leave them at 30 and 70 because that's not so important. What's more important is the look back period, because every indicator needs a certain set of data points. It needs a look back period, and the normal look back period, the normal setting here is 14 periods, whether it's daily or hours, days or hours or minutes. That's what this refers to. If we choose 14, you can see how the indicator is less volatile. Now it moves much more around the 50 level, the midpoint here. By the way, let's just add it in just for the reference. Roughly, I'm gonna paste, okay, there's no harm in being exact, so we have it at 50. Now you can see how RSI is fluctuating mostly around the 50 level with these settings of 14 periods. If we change it to something else like 5, you can see how much the indicator swings change. And this is what I like to do. I like to use a setting of 5, and you understand soon more why I do this. And here's an example. On the left hand side we have RSI with 14 periods, and on the right hand side RSI with 5 periods, and it's exactly the same data. It's the same market, and I think it was Aussie CAD or Aussie Yen, and it's hourly data in both of the charts. You can see how at the same spots RSI 14 doesn't move into overbought area, but with the setting of 5 it does. And again here this value is about 55, and here we touch 70 and move slightly above it. Why should, you might ask what's the reason I'm using these settings, and the reason is that I like to get a highlight. I like to get an alert when the price is close to potential sell levels. Let me make sure that my arrow doesn't disappear. Okay, so here the market was definitely close to levels where it started to then sell off, and then again here the market rallied and then started to sell off. If you use the 14 periods, you never get those signals unless you decide that you're going to look for, or sorry, let me phrase this differently, unless you decide that the 50 level is your threshold for overbought conditions. Now that doesn't kind of make sense, so I prefer to use a setting of 5. By the way, does it make sense this far? Everything clear? Is it easy to understand? Let me know what you think. In each and every webinar, I love to hear your opinions and your answers, so it makes me feel that I'm not alone here. Okay, Osas is saying that it makes sense. Good. Theo is saying that he didn't get the last explanation. Let me quickly recover this because it's kind of important. Maybe you missed the fact, or this bit where I showed you what happens here. So if you have a 14 period RSI or any higher number, the RSI is less reflective. It doesn't react to price swings that often. Here this is a daily gold chart, and you can see that up here we have RSI moving into overbought zone. So it's basically from this point roughly to this point. Between these two vertical lines, RSI is in the overbought area. Okay, so as per the indication, now we should be considering selling this market, and eventually that worked out. There was quite a bit of delay because the market was trending higher. But then the market doesn't move. Here we have RSI moving above, forget that. Here we have RSI moving above 50, but it never moves into above 70, which is the traditional overbought area. So no indication of market being overbought here, but the price comes down and there's several days of market moving lower, so you have several trading opportunities there. Another occasion here, no alert here if you don't start thinking that okay, it's the 50 level that is my threshold, but then you run into all sorts of problems when the market is ticking higher. So it's better to have the indicator more responsive, and I'm going to change it back to 5, and you can see how here we get an alert that the market is overbought, and then it sells off. We get trading opportunities on the short side. Here again, a really good indication that market is overbought, and then quite a move lower. The point is that you never know up here how far the market might go, so you really don't know. But you know, most of us love the idea of getting the trade entries right, and then we start to worry about the trade exits. So, okay, I'm getting a message that things are clear now. That's good. Let's move forward. So, trading with the RSI, I'm gonna give you some trading signals that we can then apply in different market regimes. First of all, I'm sure most of you have heard about bullish divergence. That's where you have RSI below the 30 value, and it creates an inflection point here. We call this P1 in this presentation. And then the RSI rallies, comes down again, and then we get another RSI inflection point or low that is actually above the P1. So you have RSI moving higher as per these two inflection points, but at the same time the price is moving lower. So this is a bullish divergence. Another buy signal that you can use is RSI crossing above 30. So here we have RSI 1 bar ago, and that's what the -1 refers to. RSI on 1 bar ago is below 30. So 1 bar ago is here. We go down to RSI and we can see it's below 30. Then the RSI on this bar is above 30, and that's at the end of this bar we have a buying signal, and the market moves nicely higher. Now you can combine this with the divergency signal if you want to. So basically you can look for divergencies and then for the RSI to move above the 30 level if you want further confirmation. But the market is a funny thing. The more you look for confirmation, the more you pay for it. Isn't it interesting? The more you are willing to accept risk, the lower is the price. But the more safety precautions you want to have, the higher price you pay for it. So obviously up here, when the RSI is positively above 30 level, the price is much higher than it was down here. But that's just the nature of market. You just have to take it into account when you decide what's the best trading strategy for you. This is the purpose of this series of videos and webinars, so that you can understand what kind of a trading strategy fits your personality, your needs and your goals. Then a higher low in RSI above 30. So recently, again, the price moves so much that the RSI is below 30. So we have an oversold condition. But then we have an additional filter here. Not only we wait for the RSI to move above the 30 level, but we want to see a higher reactionary low. And the reason I haven't placed this arrow right at this low is that obviously at this point on the close of this bar, I don't know if there's going to be a higher low in RSI. We know it at the close of this bar. And then the market moves up for 2 periods and then sideways and then up more. Any questions about these? Oh, Theo is saying he got it. Excellent, very good. While you might type in the questions that you might have, I'm gonna move on to the next one, and this is the 4th signal. This is something I studied quite a while back. This was probably 10-15 years ago, and I figured that if we apply trend analysis to RSI, we can actually get better signals than by using those other ways of defining price strength coming into the market, because at the end of the day, that's what it's all about. The market is gaining strength here and then moves higher. The same here and here, and RSI moves higher with it. RSI doesn't move the market, but the price moves RSI. That's with the same. It's the same with all the indicators. Now, with this one, you need to be a bit of an artist. You need to train your eye to see what's relevant and what's not. But as we talk about all of this in the context of different market regimes, i.e. ranges and uptrends and downtrends, this helps you to understand what kind of trend breaking signal in RSI is a valid one. So what's common for all these signals is that the RSI has recently been below 30. And then, oops, here I have a typo. It's basically okay, this is something that I sometimes wonder if I should include this in or not. It's basically, if we define RSI on this second step being less than 50, it means that we get better entry signals. But then we might filter out something like this, and it was still a valid signal. But for the purposes of getting only the best signals, we can use another filter like RSI being below 50 when it breaks a trend line. So I've taken a high there and this peak again and drawn the trend line, and then we get a signal on this candle. See that if you draw a trend line using this swing high and this swing high, the market doesn't break above the trend line above before it's here. So we're getting a lot better entry using this. And the same here. Obviously this you could have drawn differently. You could have chosen this high and then this or this high. Nothing's perfect. These are all just indicators, and they're very, very simple models of the market. The market is a complex beast, and we need to just recognize it. Then let's go to short signals. And again, if you have any questions, type them in, and I'm going to check the window soon and get back to those questions. So here we have a bearish divergence. The RSI has recently been above 70. That's the P1 point here. Then the RSI moves down, creates another high, which is here, but now in this occasion it's below P1. But at the same time the price is ticking higher. The slope here is not that strong, but it's still, the price is still moving higher over this period, and then it starts to collapse. So that's a valid signal. Then the second signal on the short side, we have RSI crossing below 70. So obviously you need to have on the previous bar, like here, the RSI has to be above 70 in order for it to cross below. When it crosses this level, that's when the signal comes. And then this one wasn't that great, the market dipped only a little, but then the next one really nailed it. The market, this is gold by the way, 1 hour chart in gold. Gold moved from about 1796 to 1764. That's about $30. That's a significant move. Then lower RSI highs below 70. So here we have RSI recently being above 70, then it moves below 70 and there's a lower high. That again can be combined with the divergency signal if you want to, like all of these. You can look for divergences only and then apply these other indicators, other signals too if you like to, but they can be quite valid on their own also. And I strongly encourage you, go and study these in different time frames with different settings. There is even a system called 2-period RSI. That's quite tricky because you get lots of these whipsaws up and down in the RSI indicator. But you should go and see how the indicator behaves, how the market behaves when you are getting indications from different RSI periods. You could use 35, 24, 21, you could use Fibonacci numbers, you could use you could use like 14, which is a 2-week period, and I think the original reason for that, 𝗿𝗿𝗱𝗏, who developed this indicator, had this idea that people's activities follow the moon phases, and that's why he chose a 2-week period for the RSI. He developed the indicator for the daily time frame, and that's why he chose the 14 periods as a sort of standard setting. Whether you believe in moon phases impacting people, that's your own problem or whatever. But I'm a big believer that the market momentum that you can identify in the market is actually a lot more important than whatever star combinations you can bring into the equation. So sorry to be this blunt, but that's my honest opinion. Then the short signal using the RSI and trend lines. A low, it's a second low and a third low, and when this trend line is broken by the RSI, we get the market sliding, and it moves down quite a bit. Then again here, this low and that low, and again we get a signal. You could have drawn another trend line here, I guess, and there was a signal which wasn't that good because the market found support. But that's the nature of trading. You get good signals, bad signals, and that's why you need to have stops in place. Whenever you trade, make sure that you are not exposed to unlimited losses. There is no business you can run by accepting unlimited losses. You have to have your income greater than your expenses. And this is what we do with trading. We look for signals, good signals, and let them run, because we don't know beforehand if it's going to be a good or bad. But it's defined by the fact that market is actually moving in the direction of the signal. When you get a signal and the market bounces back straight away, then you might want to consider either exiting the trade or just what the least you can do is keep your stops constant. So yeah, you don't risk more than 1 or 2% per trade. And then if you can make 4 or 5% in one of these trades, then that's great, because that covers a lot of losing trades. Now, you have these signals, and now we can actually go and look at the market's sort of regimes and how to use these in different regimes. Okay. First, about the range and the psychology of the range. There's a relative, whenever you have a range, there's a relative agreement in the marketplace about the fair pricing for that asset. Not so long ago, Bitcoin was moving sideways in this range. So traders within this range, they are in a relative agreement that this is a fair price for Bitcoin. Obviously, market always breaks out of these ranges, but for that period, there was an agreement. And what happens? Here at support, buyers don't believe that they should wait for the price to go any lower, and therefore they start entering their buy orders. And what happens? The price moves higher because there's a bunch of sellers that think that it makes sense to be a seller. Sorry, who don't think that it makes sense to be a seller at such a low price. They either do nothing or they turn into buyers, which is bullish. And you obviously understand that no market can move lower if there is no more flow of sellers or flow of bearish money into the market. So the market runs higher. Then at resistance, it's the other way around. Sellers don't believe they should wait for any higher prices, and they start entering short trades or selling off the holdings they had. Then at the same time, the buyers don't believe that, the buyers believe that the price is already too high for them to buy, and this is why the buyers turn into sellers, or they just do nothing, which is bearish. So that's how the market works. You need to have a flow of new money into the bulls side in order to keep the market running higher. But if the buyers lose their sort of incentive to buy, if they soon realize that there's more sellers at this level than buyers, then the market's going to turn lower. And this is something that we can see in RSI. Sorry, I meant to bring this one up. When the market moves to a resistance like here, I'm going to use a horizontal line. So the market moves to a resistance, and that's where the buyers don't believe into this market anymore. That's where RSI turns lower, price drops, and the RSI follows the price. So basically, that's what happens in the market. i.e., the indicators don't move the price, it's the price that moves the indicator. Okay, we have covered some of this already, but I just want to highlight this. When the market is in a range and it's at support, it doesn't make any sense to look for sell opportunities. And when the market is trading near to the recent resistances, recent highs, it doesn't make any sense to look for buy opportunities. It's your profit margin is very low, your probabilities of success are very low. So what's the point? You should rather just stick to the rule that when the market is in a range, you look to buys at supports and you look to sell at resistances. And that's where RSI can help you. And here's a quick, here I have in a table those strategies that you can then go back. When you watch this video, you can see how these work. You can experiment with them in your own charts. And let me know. By the way, you can always email me at on support@TIOmarkets.com, and they will send the emails to me. I would love to hear your experiences and your questions that you might have. Then in the uptrend, using the RSI in uptrends is obviously different to using the RSI in ranges. You need to wait for the market psychology to change from bearish to bullish, and obviously in a bearish market, when the market hits a resistance, it's more likely to turn lower and make a lower low. But when you see this changing, when you see the market breaking resistance levels and starting to create higher lows, that's when you know that, okay, there's a high probability that the market is actually going to trend higher, so I'm going to use my RSI indicator differently. And that's where we only look for buy signals. The RSI moves to below the 30 level, and we get, if not, nothing works 100% of the time, but there are good indications. If you combine the trend analysis with the RSI, then you have a good chance of getting it right. Does it make sense? Guys, you've been very quiet today. It's me talking here all the time, so let me hear what you think. Is this good stuff? Is it boring? Is it helping you? Is it something that you wished you never spent your time on? What do you think? Theo is saying yes. Are you saying it's rubbish or or that it's good? Osas is saying, can this RSI 5 setting be used on the 1 minute, 5 minute and 15 minute time frames? Yeah. It's basically something that you can use in different time frames. It is not something that is working only in one time frame, but you have to understand that the bigger your time frame, the bigger the presence of the big money in those moves, for just simple liquidity reasons. So if we look at a 1 minute chart here and think about it like this. Let's say that we're focusing on this resistance area here. What is the likely volume here in this area compared to, say, if we go to the daily chart and look at this resistance? It's obviously lower because in a higher time frame there's more people seeing this resistance, more people are paying attention to it, and it's basically whenever you are trading higher time frame, you have the institutional players in there, because it takes more money to actually move the market here. If you go to 1 minute time frame, these can be just little blips. This move from there to here can happen on very low volume, but if you're in a hourly time frame, the move from up there to down here, that requires quite a bit more volume. And actually, to be more accurate, we should focus on this uptrend here. How much volume do you think it takes to turn around an uptrend? Because an uptrend in gold in the daily time frame can be only initiated by and maintained by institutional money. Once the money isn't supporting the market anymore, then it starts to then the rally starts to falter and the market starts to come down. So it's better to focus a little bit higher time frame than 1 minute. If you're trading very small trading accounts, then probably you can get something out of this, but then you have the question of the spread. It comes into the play here because the spread is going to be a bigger portion of the recent range than it is, for instance, in an hourly chart or 4-hour chart or a daily chart. Yeah, okay. Let's see what else we have here. Loving it, but RSI, you're using the RSI for the first time. Okay, it's stiff. It's obviously something. This is a good point now to remind you guys that if you are hearing this for the first time, give yourself time to learn this. Don't rush into trading it. Learn, study, and see how it works with the historical prices. Go back with your charts and see how the RSI has moved in the past, how the price has moved in the past, and see if you can get it right. Obviously, gold can be a little tricky sometimes. You can have these big swings and there's no real trend. But then there are periods when you do have a trend. When you have the market moving down in a fairly nice trending fashion, you get the traditional like swings where you have lower lows and lower highs, and it's much easier for you to trade those situations. And you can see how the market sometimes kind of honors the process that's going on. It stays in that process for some time. When it's really spiky, it stays spiky for a while. When it's when there is less volatility, then that seems to be prevailing for a little while before it changes. So you need to go back, learn and study before you start using this live. Oh, lovely, Theo. Theo is saying that I've learned more in 10 minutes than I have learned in the past 3 months. Excellent. Ooh, that feels good. Thank you, Theo. It makes me feel that I'm doing what I'm supposed to be doing. Excellent. Greg is saying it's helpful. Thank you. Excellent. Lovely, lovely. So, moving forward, just a reminder, in the uptrend you can use all these signals, RSI crossing above 30, and then RSI creating a higher low above 30 after it's being oversold. So now this is not exactly an uptrend here, obviously, but if you see this signal in an uptrend, then it's a valid signal. And then RSI crossing above trend line, whether it's a range or whether it's an uptrend, you can use these signals in both those market regimes. Then quickly the downtrend. After you have supports broken, you can start thinking, okay, maybe this market psychology isn't very bullish anymore. You get market moving below supports, it's creating lower highs, so it's more likely to move down than up. This doesn't say that it's 100% sure to move lower, but it just means that the market is more likely to move lower. So we can use these RSI above 70 readings to highlight us that there's probably a trading opportunity coming up. And then the signals, when the RSI crosses below 70, when the RSI creates a lower high below the previous, RSI has recently been above 70, then it goes below 70 and creates a lower high. That's when we can have a signal. So just to clarify, this is a highlight. This is an alert for you to get ready to trade. Then these are signals to take a trade. And again, I'm not saying that this is the best trading system ever, but this could be an important lesson for you that you can take home, study and learn, and then integrate it into your trading so that you can have your best trading strategy. Greg's asking which time frame will give you the most accurate indications at a period of 5. That's quite impossible to answer, basically because all the markets are different and markets behave differently at different times. So I would say that do your market regime analysis well first. Understand where the major momentum is moving, whether it's moving up or down or sideways, and then look for these indicators. This is the part where you have to go back using your MT4 or MT5, and you need to study and see how the indicator behaves, what sort of filters I need, what's a reliable enough indication that I can actually start taking trades. Then you go and use your MT4 and do demo trades. And once you see those demo trades working, then you start using real money. But there's no point going and trading with real money unless you know that it is actually good enough to produce positive results. Han is asking which is more accurate. What are the main differences for RSI stochastics and CCI? We're kind of running out of time. I'm saving this for the next webinar, but with stochastics you have you have basically the stochastic oscillator, and then you have a moving average of that same stochastic oscillator. You can obviously, if you have some if you have some coding skills, you can create a moving average that you use in MT4 for RSI as well. Or you can go to the market and look for a free indicator. Then somebody might have built one already. We don't have that code. Basically, my examples here are from TradingView and from MT4 and these other platforms I'm using. I don't have the code here. What else? What's the best way to determine an upward or downward trend? Just 200 period MA. I would say the best way is to look at the highs and lows. If you see the market breaking supports and then creating lower highs, then you have a downtrend. You can use the 200 MA, you can use 50, 100, 30 period, 10 period MA, whichever MA you like. But at the end of the day, those are just averages and kind of approximations of what the price is doing. So if you see the price moving sideways in a range, honoring a support, honoring a resistance, and moving sideways, then you don't have a trend. That's kind of difficult to understand from a 200 period MA, but you can understand it from reading the price action itself. Okay, so good. Let's rush to the trading process because we're kind of running out of time here. So we can get back to this later and study it with sort of in more detail, but I've laid down a trading process for you. It's an kind of an example really, so that you can then maybe add something to it or drop something out if you don't feel that it's necessary. So basically, first of all, you need to answer the question if the market is moving sideways or up or down, if you have an uptrend, downtrend or range. That's your market regime. Then you define your maximum risk per trade. Actually, this is something that I would strongly encourage you to include in your original trading plan, so you don't You don't trade without a trading plan. You need to have a plan. It's like your business plan. You don't run a business without a business plan. You shouldn't run a trading business without a trading plan. So in that plan, you might have already defined your maximum risk per trade, but if you haven't, now is the time to do it. You say that I'm not going to risk more than 1% per trade or 2% per trade or 0.5% per trade, whatever is your whatever feels good to you, and whatever is justified by your results, really. I'm using 0.5% or 1% per trade quite often. Then decide how far from your entry price you will place your protective stop orders. So just to give it a picture, let's go here, and I'm going to use 1 hour chart. Okay, let's use this here. We have clearly a resistance there, and this resistance, let's go to this point. This bit here, the reason market moves lower is because we have resistance there. It rallies up there and then just collapses. So when the market comes to this point, you have to decide how far the market can move in order. So let me phrase this differently. If the market moves higher, like up there to 1837.22, if it moves up there, then I decide that I'm wrong on this trade. Then I decide that there's no point in going short anymore or staying short anymore. So that's my reference point up there. I use this method to define my risk because I want to know and focus on the point where it doesn't make any sense to be short anymore. The original trade idea is here, trade against this resistance. RSI moves above the 70 level, so we have the indications in place. If I go short at 1832.55 and if my stop level is at 1837.22, then my stop size is almost $5 relative to my trade account size, and to the fact that I don't want to risk more than 1%. It means that my trade size is going to be smaller than if I decided first that my cutoff point was 1834.39. Then it would be only about $2 away from the entry price, and then I could have a bigger position size, providing that my risk stays constant. All right. Where were we? Decide how far from your entry price the protective stop order is, and once you have defined your maximum risk and stop distance from the entry, you know the maximum position size. And write this down to stay disciplined. You need to write it down to stay disciplined. And then you prepare to trade when the RSI enters the oversold or overbought area. You enter the trade using the position size that you wrote down earlier, so that you don't give yourself a chance to just fling it, use any size you want, because you need to aim for constancy. If you're looking for one big trade, it's something that's gonna wipe out all the previous losses, then you are not trading, you are just gambling. You need to aim for consistency, otherwise you don't last in this business. So set the stop at the distance determined earlier and exit the trade when your your target is hit or the market hits your stop. That's quite simple, and you should be able to follow this. Okay. So this is all I had for today. Theo is saying that I always get stopped out. Need a better understanding of where to place the stops, but that will be a later discussion, I suppose. Yeah, there's a lot to discuss in that front, but a couple of things spring to mind. One of them is that you might actually get your momentum analysis wrong. So if you don't have the right understanding of where the market's going to go, if you're trying to buy in a down market, then you're most likely to get stopped out. If you're trying to sell in an uptrending market, then you are very probably in the risk of getting stopped out quite often. Then again, you can use just stops that are too close. You might want to be always a trader with 1 or 2 lots, and that's why you want to set up the stop to a level where your risk isn't too big, and then you get stopped out. The remedy to this is that you decide that, okay, I'm going to have, say, 1.5 times ATR, for instance, as my stop level, and then I'm going to trade a smaller size. All right, what else we have here? Okay. Theo is saying, yes, that's what's most likely happening. Thank you. The RSI will help. But please remember, it is your market analysis. It is your context analysis that makes the biggest difference. Cool. RSI interpretation is really it really depends on what market you are trading, whether you're trading uptrend, downtrend, or sideways. That's the main message of this webinar. But hey guys, you've been excellent. Thank you for your time here, and keep sending the questions in. I'm gonna hang around a little bit after the recording ends and answer your questions if you have, but we need to stop this recording so that it doesn't get too long. So thank you. Trade safe, never trade without stops, and don't risk too much per trade or per day or per week. So, and you get a video. Yeah, we'll send it out to you in email, definitely. So once again, it was great to have you here, and stay tuned for more. We can have another webinar in 1 month's time.